Welcome back to the deep dive. Today we're cracking open the Coca-Cola company's third quarter results for 2025. They just came out October 21st.
Yeah, and with a company this size, the earnings reports always make waves.
They do. Our mission today really is to look past those big headline numbers. We need to figure out where the real sustainable growth is actually coming from.
Absolutely. It's always fascinating to see how these global giants handle, well, ongoing volatility. The CEO, James Quincy, kind of set the tone right away.
How so?
He basically said the environments continue to be challenging. But importantly, he added, the company is gaining ground and strengthening our leadership position. Flexibility seems to be the key word.
Okay, and the top line numbers, they seem to back that up, don't they? Net revenues grew 5%. That's $12.5 billion.
Solid growth, yeah.
But the one that really jumps out is the earnings per share, the EPS, up 30% to $0.86.
Huge jump.
And whenever we see spikes like that, for you listening, that's always the first signal, isn't it? You've got to look deeper.
Precisely. Which is why this deep dive really has to start by defining that key difference. Reported growth versus organic comparable growth.
Right.
The gap between those two. That's where the real story of this quarter lies.
Okay, let's get into that financial engine then. Let's talk about the quality of that 5% revenue growth. Where did the money actually come from?
Well, here's the thing. It didn't really come from selling a lot more drinks. Globally, unit case volume, that's the actual number of cases they shipped it, only grew 1%.
1%. That's basically flat.
Pretty much flat, yeah, especially in a global context.
So a 1% volume increase doesn't get you 5% revenue growth. This means we're talking about pricing, aren't we? What some might call Coke's inflation masterclass.
That's exactly it. The vast majority of that revenue growth came from price mix. That contributed 6% growth.
6% from price mix alone.
Yeah, and this is probably the single most important point for you to grasp. Coke is successfully pushing higher prices. And, crucially, they're optimizing the mix.
What do you mean by optimizing the mix?
Selling more profitable stuff. Things like smaller cans, multi-packs, packages that carry a higher margin per ounce.
Okay, so that shows incredible pricing power. They're raising prices quite aggressively. Volume stays just about flat, but they still manage to gain value share in the overall non-alcoholic ready-to-drink market. NARCD.
Exactly. It suggests competitors are finding it harder to match those price hikes and keep customers.
And that pricing strategy, it must flow straight through to the profit margins.
It does. I mean, look at the reported numbers. Operating income surged an amazing 59%.
59%.
And the reported operating margin jumped to 32.0%, way up from 21.2% last year.
Whoa, hold on. A nearly 11 percentage point jump in margin. That screams comparison noise.
It does.
That tells me Q3 last year, 2024, must have had some really big, probably non-cash one-off charges dragging it down.
You got it. That's exactly right. So if we filter out that noise, look at the cleaner metric, the comparable operating margin, which is non-GAAP.
Right, the adjusted number.
That was 31.9%. Compare that to 30.7% in the prior year. So an expansion, yes, but a more realistic 115 basis points.
Okay, let's just clarify that. 115 basis points is 1.15 percentage points of improvement. Still impressive, but makes more sense.
Definitely still strong, yeah.
So what drove that 1.15 point improvement then?
That came from a 15% growth in comparable currency neutral operating income. So strip out the Forex effects.
Got it.
And you see growth driven by that organic revenue, the 6% price mix we keep mentioning, and pretty effective cost management across their system.
Okay, but I see they didn't just bank all the savings, right? They reinvested some. Looks like marketing investments were up.
Correct. That did partially offset the margin gains. You still have to spend to support those higher prices and keep demand strong.
Makes sense. Maintain that pricing power.
And then there's always the other factor for a global company. Currency headwinds.
Always a factor. How bad was it this quarter?
It was significant. Currency fluctuations knocked about 6 points off their comparable EPS growth.
6 points. Wow. That's the hidden cost of being everywhere, I guess.
It really is right now.
Okay, so if we pivot from the financials just a bit, talking only about the classic red can really misses the bigger picture these days, doesn't it?
Oh, absolutely. Coca-Cola's strategy now is all about the total beverage approach. Think functionality, health trends, variety.
Diversification.
Exactly. Diversification, future-proofing the portfolio. Yeah. They're trying to offer specific drinks for specific needs, consumer-centric solutions. And that innovation gives them more reasons, more leverage to charge those higher prices.
And this is where that zero sugar story just keeps getting bigger. You mentioned overall sparkling soft drinks were basically flat.
Yeah, roughly even. Which implies traditional full-sugar Coke volume wasn't doing anything spectacular, maybe up slightly.
But Coca-Cola's zero sugar.
That's the star.
Yeah.
Drew a massive 14% this quarter.
14%? Was that concentrated somewhere?
No, that's the key. It was strong growth across all their geographic segments. Plus, Diet Coke and Coke Light also chipped in with 2% growth.
And that's great for margins too, right? These zero sugar options.
Generally, yes. They often have a better gross profit profile, and of course, they align much better with where consumer preferences are heading regarding health.
It's a really good example of managing the portfolio well. And outside sparkling, they seem to be getting wins in some of these other, maybe more niche categories.
For sure. Look at ready-to-drink tea. Fuse Tea is doing incredibly well. Its retail value has grown 5 times faster than the industry average so far this year.
5 times. Okay.
And in sports drinks, they have that dual strategy now with Powerade and Body Armor. Together, they delivered 3% volume growth for the sports category and gained value share.
And I was really struck by the dairy segment, not something you immediately associate with Coke, but they highlighted a really interesting local win down in Mexico.
Yeah, Fairlife is their big brand in the U.S., doing well. But in Mexico, their Santa Clara portfolio actually became the value share leader in value-added dairy down there.
Really? What kind of growth did they see?
Santa Clara volume grew 13% just in the quarter.
13%. That's huge for a regional dairy brand. How'd they do that?
Seems like really targeted, localized messaging. They specifically pushed communications around the benefits of lactose-free options and flavored milk within Mexico.
Ah, so leveraging that local brand they acquired rather than just a generic global push.
Exactly. Shows the power of local knowledge and targeted marketing. It's not always one size fits all.
Okay, shifting gears from the drinks themselves. Let's talk about the structure of the company, the franchise model. This is always going on in the background and affects those non-GAAP numbers we talked about.
It's a constant process, this refranchising. It's where Coca-Cola sells off its company-owned bottling operations to independent local partners.
And the goal isn't just financial, right? It's strategic.
Primarily strategic, I'd say.
Yeah.
They want to shift the capital intensity, the cost of building and running bottling plants onto these local experts. Coke itself wants to focus on the brands, selling the concentrate, the marketing, being asset light.
And we saw a couple of big moves on this front in Q3. First one was in Africa.
That's right. Coca-Cola HBC, CCHBC, which is a big independent bottler, mainly in Europe, agreed to buy a controlling stake in Coca-Cola Beverages Africa, or CCBA.
So consolidating bottling power in Africa under a trusted partner.
Essentially, yes. Putting CCBA's growth into the hands of a large, experienced bottler with regional know-how.
And the second big move was in India.
They continued their refranchising push there. They sold a 40% stake in Hindustan Coca-Cola Holdings, that's their bottling arm, to the Jubilant Bhartia Group.
Another strong local player, same logic, different region.
Exactly. Gain local expertise, reduce Coke's own capital tied up in bottling assets.
Okay, let's maybe do a quick run through the geographies. It really highlights that price versus volume story. Where is the balance best?
I'd say Europe, Middle East, and Africa, EMEA, looked the most balanced this quarter. They had strong volume growth, up 4%.
Okay.
And their price mix was also up 4%. So that's pretty healthy, balanced growth. Volume and price contributing equally.
Right. Now contrast that with Latin America. That seemed like the extreme example of relying on price.
It really was. Latin America's volume was dead flat, 0% growth.
Zero.
But they had the highest price mix growth globally, up 7%.
7% price mix on flat volume. Why so aggressive there?
Well, partly fighting local inflation, but also battling a huge currency headwind. Forex knocked 8 points off their reported revenue growth in LATAM.
8 points. So they almost had to raise prices that much just to stand still in dollar terms.
Pretty much. Aggressive pricing was essential just to offset that currency drag. Though, credit where it's due, they still managed to gain market share in key places like Brazil and Argentina.
And North America looked somewhat similar to LATAM, maybe without the massive currency issues?
Yeah, similar profile. Volume was flat, 0%, but price mix drove 6% growth. Again, the business engine was almost all about pricing and getting people into more profitable packages. Sports drinks helped the water, sports, coffee, tea category there.
And Asia Pacific looked like the toughest region for volume.
It was. Volume declined 1% there, mainly due to weakness in some sparkling flavors other than Coke. But even with volume down, price mix was up 8%.
8% again. So that reliance on price really is a global thing for them right now.
It seems to be the core strategy, yeah.
Okay, let's look at financial health, cash flow. There was a significant update to the 2025 guidance here, but it needs a bit of explaining.
Yes, this is important. The company actually raised its outlook for free cash flow for the full year. They're now targeting at least $9.8 billion.
Okay, up from $9.5 billion previously. That sounds good, but there's a catch.
There's a footnote, a very big footnote. That $9.8 billion number excludes a major payment they made earlier in the year.
Why exclude a payment? Isn't free cash flow meant to capture everything?
Normally, yes, but sometimes huge one-off items can distort the picture of underlying performance. In this case, remember Fairlife, the dairy brand.
Yeah.
There was a massive contingent consideration payment related to that acquisition. They paid out $6.1 billion back in Q1 of 2025.
$6.1 billion. Okay, I see. So if you include that huge one-time outflow, the full-year cash flow would look artificially low, even if the core business is generating cash well now?
Exactly. It's like, imagine you paid off your entire mortgage in January. Your bank balance looks rough that month, but your ongoing income might still be strong. Excluding that big payment gives analysts a clearer view of the current cash generation ability.
Right. The clean metric for ongoing operations. Makes sense. And the rest of the outlook, did that change?
Nope. The rest looks stable. Still expecting organic revenue growth for the full year between 5% and 6%.
Okay.
And comparable currency-neutral EPS growth still targeted around 8%.
And quickly on debt, leverage looks okay.
Seems quite manageable. They reported net debt leverage at 1.8 times.
1.8x. Pretty standard.
Yeah, that's based on about $31.6 billion in net debt against almost $18 billion in comparable EBITDA as of late September. Well within comfortable limits.
Okay, so let's try and wrap this up. Bringing it all together, what's the main story from Coca-Cola's Q3?
I think it shows a company delivering pretty resilient growth, in a still tricky global economy. But crucially, how they're doing it has shifted.
It's not about selling much more volume.
Not primarily, no. It's really about two things. First, that inflation masterclass, successfully pushing through price increases and optimizing the mix, that 6% growth engine.
And second?
Second is the portfolio future. Really leaning into innovation, especially zero sugar with that fantastic 14% growth, but also getting strong wins in niche areas like Fused Tea or Santa Clara Dairy.
So it's a combination of pricing power on the core and smart growth in newer categories.
Exactly. It's a blueprint, maybe, for maximizing profit when you can't rely on massive volume gains anymore. Control what you can control. Innovation, price, and structural efficiency like the refranchising. Use those to fight off inflation and currency swings.
Which brings us nicely to our final thought, something for you, the listener, to chew on. We started with those eye-popping reported numbers, 59% operating income growth, 30% EPS growth.
Yeah, the big headlines.
But we pretty quickly established that a lot of that surge was, well, noise. It was due to comparing this quarter to Q3 last year.
Which was hit hard by big non-cash charges. Things like writing down the value of the Body Armor trademark or adjusting the liability for that Fairlife payment we just discussed.
Right, these huge adjustments related to past acquisitions or restructuring.
And these kinds of things, big M&A deals, refranchising entire continents, writing down intangible assets.
Yeah.
They're becoming almost routine for these massive global companies, aren't they?
It seems like it, constant transformation.
So when the companies themselves have to keep adjusting for these multi-billion-dollar, often non-cash items, they end up relying really heavily on these complex non-GAAP metrics to show what they see as the true underlying health.
The comparable, organic, currency-neutral view.
Exactly. Which leads to the question for you. As these giant companies continue these big structural changes, the refranchising, the massive acquisitions, the subsequent write-downs, are we, as investors or observers, ever going to get away from relying on these complex, adjusted non-GAAP numbers? Or is this complexity, this need to constantly filter out the noise, simply the new reality for understanding the core performance of these global titans?
A provocative thought indeed. Is non-GAAP the only way forward? We'll leave that with you. That's our deep dive into Coca-Cola's Q3 2025 results. Thanks for joining us.
See you next time.